Since December of 2020, I have uploaded 99 videos attempting to oversimplify the complexities of the United States income tax system. But one question I have never answered is why? Why does this channel need to exist? Why has our tax system evolved to a point where it's just about impossible to comply with the income tax laws without either a computer or a paid tax professional with a computer? I'm the Tax Geek, and in this video I'm going to try to answer the question, why are taxes so complicated? Rarely does a year go by that Congress doesn't make at least some changes to the tax code. Since the last more or less top-to-bottom rewrite of the tax code in 1986, the code has been changed thousands of times, mostly as part of broad-based legislation. There have been attempts to simplify the tax code. The original intent of the Tax Reform Act of 1986, which created the framework of the tax code we use today, was to create a simpler, more streamlined tax structure with only two marginal tax rates. Tax capital gains the same as all other income, introduce a larger standard deduction and personal exemption, and eliminate, restrict, or reduce many tax deductions. Which it did, for a very short time. You see, Congress has long used the tax code not only as a means to raise revenue, but also as a means to encourage certain behaviors through the creation of tax incentives in the form of deductions or tax credits. By promising people a lower tax bill or a larger refund, the government can do such things as encourage people to purchase homes, have or adopt children, purchase health insurance, pursue higher education, save for retirement, or give to charitable causes. Every one of these incentives adds complexity to the tax code. But Congress still needs to raise revenue, but raising taxes is, spoiler alert, extremely unpopular. So instead, Congress tries to reduce or eliminate some of these tax advantages. However, Congress finds it extremely difficult to eliminate these incentives once they're enacted. The problem is that every deduction, credit, or other tax advantage enacted by Congress gains a constituency comprised of taxpayers who benefit from that tax advantage. Some of these constituencies are very vocal, making any attempt to eliminate any tax advantage difficult if not impossible. So, instead of eliminating these advantages, Congress subtly modifies them, adding restrictions that perhaps make them a little more difficult to take advantage of, usually for people at higher income levels. And every one of these actions further increases the complexity of the tax code. Let's look at 6 different parts of the tax code and see how they become more complex over time. Deductibility of interest paid on loans has been a part of the tax code since the first modern income tax code was enacted in 1913. The 1986 code limited the deductibility of interest. Personal interest on auto loans, credit cards, personal loans, and student loans would no longer be deductible. But to soften the blow for those deducting large amounts of personal interest, these deductions would be phased out over 3 years. Mortgage interest remained deductible, but only on up to 2 homes and only on mortgage indebtedness up to $1 million. But this is only for loans written after 1986. All previously written loans used the pre-1986 rules. And within a few years, after hearing from people who weren't allowed to deduct student loan interest, Congress reinstated the deduction, this time as an adjustment to income rather than an itemized deduction, and imposing an overall limit of $2,500 in student loan interest per return, and limiting the deduction to those with incomes below certain levels. Then, in 2018, the mortgage interest deduction was further restricted to loans less than $750,000, but this limitation only applied to mortgages originated after 2017. Loans originated before 2018 could continue to use the old limitation. So now we had 2, and possibly 3, sets of rules covering the same deduction. Also, in 2018, taxpayers could no longer deduct interest on most home equity loans. Finally, in 2018, a limitation on excess business interest was enacted. Businesses that are affected by these restrictions need to file a 3-page form to comply with them. As you can see, we've come a long way from all interest is deductible. The Tax Cuts and Jobs Act, which took effect in 2018, was touted as both tax reform and tax simplification. And here are some of the results. A new 1/2 page simplified 1040 replaced the existing 1040, 1040A, and 1040EZ. But since nothing was truly eliminated from the tax code, 6 new schedules were created for items that were still in the tax code but not included on the new 1040. Many tax preparers, myself included, hated the new 1040. Explaining a tax return to a client now involved constantly flipping through several schedules to show where each number came from. As a response to preparer feedback, the form has since been expanded back to 2 full pages and the number of the supporting schedules reduced to 3. But a major shortcoming of the Tax Cuts and Jobs Act is that a number of deductions were eliminated for some taxpayers but retained for others, meaning that now 2 sets of rules exist where only one existed before. We've already looked at the Act's effect on mortgage interest, but here are a couple of others. The adjustment for job-related moving expenses was eliminated for most taxpayers, but it was retained for members of the armed forces. Under the new law, alimony was made non-reportable as income and non-deductible as an expense, but the original rules were kept in place for agreements made before December 31st, 2017 that divorced couples could use if they wanted. Finally, every provision of the Tax Cuts and Jobs Act is temporary, expiring in 2025, which means in 2026 we'll have to completely reverse gears and prepare taxes using pre-2018 law. And the Act's qualified business income deduction deserves a section of its own, which is coming up next. The intent of the Qualified Business Income Deduction was to give smaller businesses that were not structured as C corporations a tax reduction comparable to the significant reduction in the corporate tax rate. The result was a deduction that depended on 5 different factors and is calculated 5 different ways. You may have already seen this video that was an introduction to the Qualified Business Income Deduction, but it only covers the simplified computation. At higher income levels, the deduction becomes orders of magnitude more complex. To calculate the qualified business income deduction for a taxpayer with ordinary taxable income between low and high thresholds takes a 12-step process, which is currently being written on the chalkboard and is reported on yet another 2-page form with up to 4 attached schedules. If you can't follow the calculation, well, neither can many highly experienced tax professionals. At this point, I have no choice but to ask, who came up with this calculation? What type of twisted mind is capable of devising such a thing? If anyone knows, please leave a comment. Moving on. Capital gains tax has been the subject of several videos on this channel. Several videos were required to break down capital gains into smaller chunks that are easier for people to understand. The Tax Reform Act of 1986 greatly simplified capital gains tax by taxing them like any other income. Since the top marginal tax rate was now relatively low, it was felt there was no need for preferential rates for capital gains. This changed as the top marginal tax rate rose again through the 1990s and 2000s, so preferential rates were once again reintroduced for capital gains. Today, gains on the sale of capital assets can be taxed at any one of, or a combination of, 5 different rates. When this tax is calculated, it is then compared to the ordinary income tax on those gains, and the lower amount is the actual amount of tax. Depending on what type of capital assets you are selling, capital gains tax is calculated on either this 1-page, 25-line worksheet, or this 2-page, 47-line worksheet. And because qualified dividends are also taxed at capital gains rates, any taxpayer that has more than a few dollars in qualified dividends needs to complete the 25-line qualified dividends and capital gains worksheet to calculate their tax. It leads me to wonder how many people who prepare their taxes by hand with pencil, paper, and calculator don't even bother with the worksheet and pay more tax than they should. Prior to 2023, the federal plug-in electric vehicle credit was relatively straightforward, with only a couple of complications. The credit was a non-refundable credit of up to $7,500 based on the capacity of the battery in the vehicle. The only additional complication was that as a manufacturer produced over 200,000 vehicles, the credit would no longer be available for that manufacturer's EVs. In 2023, electric vehicle credits will change as the result of the Inflation Reduction Act. In addition to being based on battery capacity, the new credit will only be available to vehicles assembled in North America with battery components also produced in North America. The 200,000 vehicle manufacturer cap was eliminated, but the new credit has a cap on vehicle prices and income limitations that prevent people with higher incomes from taking the credit. There is also a new credit of up to 30% of the price of the purchase of a used vehicle with a maximum of $4,000. But the vehicle must cost less than $25,000 and must be at least 2 years old. And finally, starting in 2024, you will be able to take the credit in advance to reduce the purchase price of the vehicle at point of sale. Since this is an advance credit and income limitations are in place, the advance credit will probably have to be reconciled with the actual credit when you ultimately file your return. The clean vehicle credit is thus a classic example of making something that's relatively simple much more complicated. The Affordable Care Act essentially uses the tax system to encourage people to obtain health insurance by offering them a tax credit for doing so. In the initial years the Affordable Care Act was in force, it also used the tax system to penalize those who didn't obtain health insurance. This particular penalty, easily the least popular part of the Affordable Care Act, was dropped as part of the Tax Cuts and Jobs Act. Now, offering people a tax credit for purchasing health insurance seems fairly straightforward until you take a look at how the credit is calculated. A typical calculation of the premium tax credit is being shown on the chalkboard, another 5-step process that requires consulting 2 different tables. In addition to that, an estimated amount of the credit is advanced to most taxpayers monthly to offset their health insurance premiums. The estimated credit then has to be reconciled with the actual credit, and the difference either collected from or refunded to the taxpayer. And if you're a small business person who claims both the premium tax credit and the self-employed health insurance deduction, here is what happens. Your premium tax credit is based on your family income, which includes your adjusted gross income. Since the premium tax credit affects your health insurance premium, which in turn affects your self-employed health insurance deduction, which affects your adjusted gross income, which affects your premium tax credit, which once again affects your income, which affects your premium tax credit, which affects your income, which affects your premium tax credit, which affects your income, which affects your premium tax credit, which affects your income, which affects your premium tax credit, which affects your income. And probably the worst thing about the Affordable Care Act is that it more or less invented the concept of advancing tax credits and reconciling them when the tax return was filed. And this concept was used for the 2020 and 2021 recovery rebate credits, the 2021 child tax credit, and will probably be used for the new EV credit. And I haven't even touched upon other complex parts of the tax code, such as the alternative minimum tax, kiddie tax and nanny tax, net investment income tax, additional Medicare tax, and many others. Most of these subjects will be tackled in future videos as soon as I can figure out how to oversimplify them to the point where you can easily understand them. I hope you enjoyed this deep dive into the complexities of our tax system and found it to be at least interesting. If you did, please give the video a thumbs up. If you want to see oversimplifications of these topics and many more, please subscribe. And of course, your questions, comments, suggestions, and the occasional complaint about our tax system are always welcome in the comment space below. Thanks for watching this video and helping me celebrate the 100th video uploaded to this channel. And I'll be back soon with more of your overcomplicated taxes oversimplified.